Once again, good morning. Our class this morning, we shall round up on transfer pricing, for those that were in class last week. We started the topic transfer pricing last week. So for the first 1 hour, all things being equal, we shall round up on this topic. A quick recap of our last class. We defined transfer price as the price or the monetary value for goods and services exchanged between two divisions of the same organization. We explained that where a company is operated along divisional structure, where your company is operated along divisional structure, one division may produce components that is required by another division within the same organization. That means division 1 we sell goods to division 2. Both divisions belongs to the same organization. Now the question is, at what price with division 1? At what price will division 1 sell goods to division 2? The price at which transactions are valid between divisions of the same organization is what we call transfer price. Look at the example of Dangote. We have Dangote sugar. We equally have Dangote flours. To produce flour, you require sugar. Dangote sugar can sell sugar to Dangote flour. Dangote flour can buy sugar from Dangote sugar. Remember, both companies belong to the same organization. So the question is, at what price will this transaction be valued? That is the transfer price. Transfer price is the price for interdivisional transaction. We explained this last week. We explained the condition for transfer pricing. That for you to talk of transfer price, the company must be operated along divisional structure. Number 2, divisions must be independent. Number 3 conditions, divisions must be identified as profit center or investment center. Condition 4, one division must produce components required by another division. We explained this last week. We equally discussed the quality of a good transfer price. A good transfer price must allow for performance evaluation. It must guarantee divisional independence. It must encourage initiative and motivation. It must promote congruence. We explained this in our class last week. We now discuss method of transfer pricing. We have cost-based transfer pricing, market-based transfer pricing, negotiated transfer pricing, arbitrary transfer price, and we have transfer price based on opportunity cost. This was discussed in our class last week. We now looked at how to identify optimal transfer price. What is optimal transfer price? That transfer price that will maximize the profits of a company. Optimal transfer price. The transfer price that will maximize the company's profits. In just 1 minute. All right. I'm trying to invite other students. The number is quite small. To identify transfer price, you are going to start by identifying the arrangements for transferring goods internally that will maximize the profit of the company as a whole. That transfer price that will maximize the profit of the company. That is, what solution, what transfer price is in the best interest of the company. Number two, we said, haven't identified the plan that is in the best interest of the company. Identify the transfer price or a range of transfer prices that will motivate the manager of the buying division to work towards the best plan. And the last point, haven't identified the transfer price, determine the transfer price or a range of transfer prices that will motivate the selling division to be willing to work towards what is in the best interest of the company. This was discussed in our class last Sunday. Thereafter, we treated two questions. We treated question number 2 and question number 3. Today, by God's mercy, we are going to take one more question on this topic. Please refer to your study pack, page 95, question number 7. Please refer to your study pack, page 95, question 7. Let us look at this question together. Please, can somebody confirm you have opened this pack?
Yes, sir.
All right. MD. We go to the question. X and Y division are two divisions, are two arms of X and Y group of company. Division X manufacture one type of component which is required, which is set to external customer and also to division Y. The following information relate to division X. Listen to that. Division Y manufactures one type of component which it sells to external customer and also to division Y. Division Y is internal customer. The following information relate to division X. Market price per component, 200 naira. Variable cost per component, 105. Fixed cost of division X, 1.3,750,000. Demand from division X, 20,000 components per period. Capacity of division X, 35,000 components per period. Next, division Y assembles another type of product which is sells to external customers. Each unit of that product requires 2 units of the components that are manufactured by division X. The following information relate to division Y. Selling price per unit, 800. The variable cost per unit, 1. 2 components from division X, 2 times transfer price. Other variable cost, 250 per unit. Fixed cost of division Y, 900,000 per period. The demand, 10,000 units per period. Capacity of division Y, 10,000 units. Please bear in mind, division Y division only sell to external customer. Like I said in class last week, there is the possibility that you are going to deal with one question on this topic. All right. Group transfer price policy. transfer price must be at opportunity cost. Please note, if transfer price is at opportunity cost, that opportunity cost will lead to market price. Let me repeat that point. If transfer price is at opportunity cost, that transfer price will lead to market-based transfer price. So if examiner says transfer price is at opportunity cost, at the end of the period, you are going to transfer at market price, provided there is no spare capacity. You are going to transfer at market price, provided there is no spare capacity. There is no excess capacity. All right? That division. Division Y must buy components from X. Management says division Y must buy all its components from division X. That means division Y cannot buy from outside. You must buy all your components from division X within the same organization. Now, requirements. A, calculate the profits for each division. If the external demand per period for the components that are manufactured, that are made by division X is 15,000 units, 19,000 components, 35,000 components. All right. Examiner says calculate the profits for each division. You now ask yourself, if I'm to calculate profits, what do I require for the calculation of profits? I must be able to get sales revenue minus total cost. For me to calculate profits, I must determine the revenue and the total cost of these divisions, bearing in mind the transfer arrangements. All right. We can go to this question now. Please get your pen, your writing material. Please, whatever solution, my advice is that transfer to your notes. Also, get your calculator ready. All right. We have three scenarios. Look at your screen. Calculation of profits of division Y. Sorry, division X. Now go to the question. What is the maximum capacity of division X? Look at it, please.
35,000.
Maximum capacity of division X, 35,000 units. Pick that. What are the external demand? We are given three scenarios. The external demand can be 15,000 per unit, 15,000 units, 19,000 units, or 35,000 units. We are given these variables. Look at it. Maximum capacity of division X, 35,000, 35,000, 35,000. Scenario 1, 2, 3. External demand for the component of division X. It can be 15,000 or 19,000 or 35,000. If you are faced with this, determine if there's spare capacity. Determine if there's what? Spare capacity. Compare 35,000 and 15,000. The difference will give us 20,000.
20,000.
Compare 35 and 19. The difference will give us what, please?
15,000.
16,000.
16,000.
Thank you. 35 minus 35. Nil.
Nil.
Thank you. Now ask yourself, what is the ID transfer price for spare capacity? What is the appropriate transfer price for spare capacity? The question is to the class. We discussed it in our class last week. Yes, we are waiting.
So it should be at the marginal or variable cost.
Thank you, Rose. The ID transfer price for spare capacity is the variable cost of manufacture or marginal cost of manufacture. That means this 20,000, this 16,000 will be transferred to division Y at the variable cost of manufacture. Now go and check the question. What is the variable cost of manufacture for division X? Variable cost per component. 105. Thank you. The ID transfer price for spare capacity is the variable cost of manufacture of the selling division. The selling division in this question is division X. You are going to pick that price. Look at it. For internal transfer, one transfer price will be the first transfer price is 105. The first transfer price is 105. This spare capacity transferred internally to division Y will be priced at the variable cost of manufacture. Next, examiner says division Y must buy components from division X. We now ask ourselves, how many components does division Y require? How many components does division Y require? Look at it, please. Demand from division Y, 20,000 components per period. Division Y requires 20,000 components. And the reason is, look at it here. Examiner says, look at this point, please. Look at this paragraph. Division Y assembles another type of product, which it sells to external customer. Each unit of that product requires 2 of the components that are manufactured by division X. Now, to produce 1 unit of the product of division Y, it requires 2 components of X. Now, if you produce 10,000 product for Y, you are going to produce 10,000 units for Y. And to produce 1, you require 2 components. That means you must get 20,000 components to be able to produce 10,000. Is that clear, please?
Yes, sir.
Good. That means division Y must get 20,000 components. Look at scenario 1. We have spare capacity of 20,000. That means this will satisfy the request of division Y. Is that not, please? You can unmute, don't worry.
Yes, it is.
Yes, sir.
That means for scenario 1, the 20,000 is complete. Here, external demand, but transfer internally. We don't need to transfer anything here again. External demand, but transferred internally. Because this 20,000 units is sufficient to meet the request of division Y. Now look at scenario 2. We only have 60,000. That means out of this external demand, we need to reduce it by 4,000. Is that not? To be able to complete 20,000 needed. Look at it.
Yes, sir.
External demand, but transferred internally. Mr. Ahmed, did you join this class?
Sir?
Are you in this class?
I'm in this class. I thought that it's for every one of us.
Okay, but you know I've not started the topic in your class.
That is what I wanted to say earlier, because I saw the link that you join the class by
no, where you can just benefit. I'm still going to take you this topic tomorrow.
Okay, no problem then.
You can benefit from it. It's supposed to be for only our VI students, because we have not started this topic at the online class here. But you
Okay.
can stay and benefit.
Thank
No
you, sir.
problem. But bear in mind, this topic will be treated tomorrow in your class.
Okay. Thank you.
So, okay, but that's fine. If you join, it's for your benefit. That will even save me some stress more. Now, what we are trying to explain is that the external demand here is 19,000, but we must fulfill the demand of division Y. That means we are going to reduce this 19,000 by 4,000 units to be able to complete 20,000 to division Y. Now look at this scenario. We have 35,000 external demand, but we must set 20,000 to division Y first. That means we are going to reduce this by how many? 20,000 units.
20,000.
Yeah. So you can leave your speaker, provided you can control the noise in your house. Promise. The promise in charge.
Yes, sir.
All right. That means external demand satisfied. For scenario 1, we can satisfy external demand 15,000. For scenario 2, external demand is 19,000. But we cannot meet this. We need to reduce it by 4,000. We can only meet how many? 15,000. For scenario 3, external demand is 35,000. But we must transfer 20,000 internally. That means we can only meet how many?
15.
Good. Now, this external demand, we have 2 external demand. External demand transfer internally. This external demand transfer internally, we are going to transfer it to division Y, but it's going to be at the market price, opportunity cost. We have the opportunity to sell to outsider at 200 naira. If I don't want to sell to my customer internally, I will still sell at that 200 naira, which is the market price of division X. Look at it. So that those units that can be sold externally but transfer internally will be priced at the market price, because examiner says transfer should be at opportunity cost. In this case, second transfer price 200 naira. You can now calculate. Our internal sales is that sales made by division X to division Y. Look at it. Spread capacity 20,000 units. Transfer from division X to division Y. That would be at 105. Multiply 20,000 by 105. Assuming 30 up.
2.1.
2.1 million. Thank you, sir. Here, there's no external demand transfer internally. Nil. Here will be nil. Next. Spare capacity transfer internally. 15,000. This will be at variable cost. Multiply by 105. What do we have?
1680.
1680.
1680. Now, this 4,000 external demand, but we transfer it internally. It's going to be at the market price because there's opportunity cost. 4,000 multiplied by 200.
800,000.
800,000.
800,000. Scenario 3. There is no spare capacity here. This will be nil. External demand, transfer internally, 20,000. This will be at the market price, multiplied by 200.
4 million.
4 million. That's 4,000. 30 up. Now get your total internal sales. Internal sales value. Here, 2,100. Please sum. Here,
2480.
2480. Here we have 4,000. That is the total internal sales value. Division X, we get revenue. Division Y, we incur cost. So bear in mind. Now, external sales. External demand satisfied. This will be at market price, 200. External demand satisfied, 15,000 multiplied by 200. What do you have? That should be 3 million.
3 million.
15,000 multiplied by 200. This will be 3 million. Hold on. You can now get your total sales revenue. Internal sales plus external sales will give you total sales value. 5.1 million.
548.
548.
7
million. You have gotten your total sales revenue for the 3 scenarios examiner has created. Now, total cost. Variable cost. Division X will produce 35,000, the maximum capacity. Variable cost per unit is 105. Multiplied by 35,000. Look at it here. Maximum capacity. You are going to produce 35,000, 35,000. Both for internal sales and external sales. How much here?
3675.
3675.
3675. 3675. 3675. Now go and look at the fixed cost of division Y. How much? 1,375.
Is
1375. 137
division X.
of division S, yes, sorry. 1375. Now sum of the two. Variable cost, total variable cost, and total fixed cost. That will give you total cost.
5050.
5050. 5050. 5050. Your profit is revenue minus total cost. Revenue 5,100 minus total cost 50/50. This is 50.
430.
430.
1950.
1950. You are done with division X profit calculation. You are done with division X profit calculation. We now move to division Y. So if you carefully study this, environment, you can pick a good mark in your exam. Now, calculation of profit of division Y for each of the scenario. For each of the scenario. Let me create a space here. No, here. Yeah, it's better here. First, what is the maximum demand of division Y? When I say demand, look at it, please. For division Y, look at this. Demand for division Y, 10,000 units.
10,000 units.
Capacity 10,000 units. That is what the customer of division Y wants to buy. Demand for division Y is, division Y can meet its customer demand. There is nothing like spare capacity here. In fact, division Y does not sell internally anyway. You come here. The selling price of division Y. Look at, let me even walk it straight. Division Y selling price per unit, 800.
800.
The demand is 10,000 units. Please get revenue for division Y. That should be 8 million.
8 million.
8 million.
Yeah.
Whether scenario 1 or 2 or 3, the revenue is 8 million.
8 million.
Now, cost of division Y. Please bear in mind, like I explained in the class, once you have internal sales, division S is selling products, is selling component to division Y. To division Y, that transaction, to division X, that transaction is a revenue, it's an income. To the selling division, that transaction is an income. To the buying division, that transaction is a cost. So look at it. Your cost. You are going to start with internal sales, in total internal sales value. What is value to division X is cost to division Y. Here we have 2,100, 2,480, 2,000, 4,000 rand. I will come here. Internal purchase cost. This is 2,100, 2,480, 4,000. What is income to division X is internal purchase cost to division Y.
Right.
Now, other variable cost. Let's go to division Y. That cost we pick
250.
is, thank you. We have treated this. This is the internal purchase. This is the internal purchase cost. We have treated it. Other variable cost per unit, 215. Division Y, we produce 10,000 units. Come here.
That's 2.5.
250 multiplied by 10,000.
0.5 million. 2,500.
Yeah, I think I want to be sure. 2,500. 2,500. 2,500. Now go and pick the fixed cost of division Y. How much?
900,000.
900,000. 900,000. 900,000. Please get the total cost incurred by division Y, starting from 2,100.
5,500.
5,500.
How much, please?
5,500.
Oh, 5,500. Next.
5,880.
5,000.
880.
880. Next. 7,000.
400.
400. You can now get your profits. Revenue minus total cost. Let's go up small.
2,500.
8,000 minus 5,500.
2,500.
2,500.
2120.
2,120.
20.
600 for the last.
2,120. Next.
600.
600. You are done with requirements 1. This will give you your
Easy maths, you pocket it.
1,300.
Yes, so
Wow.
You pocket it.
pocket it well.
And I look for 85
Mr.
marks.
Saju, can you go up to the first solution?
What do you say, sir?
The first solution.
First solution we're copying.
Division X.
Yes, sir. Division X.
You want to look at it or what?
Yes.
Okay.
And the end part.
If you are copying, it's fine. Because it helps you to also be alert in the classroom.
Yes, sir.
But I have to share the solution. Is that clear, sir?
Yes, sir. We're done.
All right, requirement B.
Can you please go to division Y?
I can hardly hear the person speaking.
I said, can you please go to division Y, please?
Division 1. Why? Okay, division Y. All right, we go there, don't worry. But let's look at B.
I want to ask you a question.
There's a question.
I want to know how you calculate. I missed the spot here. My network was very bad. The internal purchase cost, I just want to know how you calculated that. The internal purchase cost.
The internal purchase cost, yes.
Can you please go all over it? Just look to
Okay. How do we derive the internal purchase cost? Now, please listen again. Look at the internal sales value. Division X we say component to division Y. 2.1 million, 2.480, 4 million. That internal sales value of division X represents the internal purchase cost of division Y. Is that clear?
Yes, sir. Yes, sir. Thank you.
Badmus, is that clear?
Yes, it's clear, sir. Thank you.
All right. Requirement B. Calculate the financial impact on the group if division Y ignored the transfer pricing policy and purchased the 20,000 components it needs from external suppliers for 170 naira each. Your answer must consider the impact at each of the 3 levels of demand: 15,000, 19,000, 35,000 components from external customer for the component manufactured by X. Please, if you are faced with requirements, my suggestion to students is try to explain that requirement to yourself. One of the problem I noticed with PM is that it does not give room to cramming. It's always scenario based. If you are dealing with taxation, if you understand the tax rule is always stated. That will not change. If you are dealing with FR, once you're able to understand standard has provided guidance on the treatment, no issue. But for performance management, there is nothing like standard. Question will be based on scenario. Now back to this requirement. The financial impact on the group. If division Y decided to buy components from external supplier, that means we are going to compare it. If I buy from division S, how much will it cost me? If I buy from outside supplier, how much will it cost me? We now compare the two costs. I have a choice. If I decide to buy from division Y, how much will I incur? That is your internal purchase cost. That internal purchase cost is the cost you are going to incur if you buy from division X. Alternatively, if you buy from external suppliers, how much will this component cost? We can now compare the two costs. Is the cost increasing or decreasing? That will tell us the impact on the group. Now look at it. If I come here now, these are three scenarios. Cost of component transfer, that is your internal purchase cost. If you buy internally, it's going to cost us 2.1 million here, 2,480,000, 4,000 here. Now, if you buy from external supplier, you are going to buy 20,000 components at 170. Please, how much will that cost you?
3.4 million.
3.4 million, 3.4 million, 3.4 million. Now compare. Look at the first option. If you buy internally, you are going to incur 2.1 million. If you buy externally, you are going to incur 3.4 million. That means you have increased the cost of the business. What will happen? Incremental cost. Is that not the difference?
1.3.
That means our cost will increase by 1.3. Then if your cost increase, what happens to your profits?
It will decline.
It will decline. Thank you. That means if division Y decided to buy from outside under scenario 1, the company's profit will reduce by 1.3 million.
1.3.
Look at scenario 2. If you buy internally, you are going to incur 2,480,000. If you buy from external customer, external supplier, you are going to incur 3 million. That means your cost has also increased. The difference?
9.20.
920. If your cost increased by 920, then profit of the company will reduce by how much?
9.20.
In brackets. Scenario 3. If you buy internally, you are going to incur 4 million. If you buy from external supplier, you are going to incur 3.4. What has happened to your cost?
You saved cost by 600.
600. Your profit increased by 600. You are done. Please, in exam, may God give us a better understanding. There are some questions you should not waste time. You are done with requirements C. For requirement B, the last requirements. Requirement C. explain two attributes of a good transfer pricing policy. Yes. What are the qualities of a good transfer price? The class is open. Yes, who is speaking first?
A good transfer price must encourage initiative and also motivation.
Correct. A good transfer price must encourage initiative and motivation. Divisional manager initiative, and they must be motivated to be involved in internal transaction. That is number 1 point. Number 2 points.
Must promote Go Congress.
Yeah, number 2 points. A good transfer price must promote Go Congress. That is Go alignment. What is Go alignment? The transfer price must ensure that divisions act in the best interest of the company as a whole. The transfer price must encourage division to act in the best interest of the company so as to avoid suboptimality. Your transfer price, there must be Go alignment. Go Congress. What is Go alignment? If the objective of the company is to make profits, the objective of Dangote as a company is for profit maximization. That means all divisions must work towards profit maximization. Dangote cement objective must be to maximize profits. Dangote sugar objective must be to maximize profits. Dangote salt objective must be to maximize profits. There must be Go alignment. The objective of the company must align. That is Go Congress. All right. We are done with this question. And by extension, we are done with this topic. We have treated 3 topics. We treated question number 2 in our physical class last week. Question number 3 last week. And we have done question number 7. So we are going to round up on this. Then we now move to the next topic. Your next topic is budgets. All right, we have spent 1 hour of lecture. So I'm going to share the budget material now. All right. Your next topic is budget. Yeah. Budgets and budgetary control. Sitting down after you get tired. Budget and budgetary control. Under this topic, we shall be discussing what is budgets. Why do companies prepare budgets? Do we need to prepare budgets really? Why do we need budgets? What are the types of budgets? that you may be required to prepare. What are the benefits of budgeting? Of course, budget is a critical part of company's control. Budget is a critical part of the control system. Even as an individual, you must be able to have a budget. Otherwise, you are going to be spending money without a direction. So what is budget? We can define budget as plan expressed in monetary terms. Budget can be defined as plan expressed in financial terms. A budget is a plan stated in monetary value. If you draw your plan, I plan to write ICAN within 2 years or maximum 3 years. I should be able to complete this ICAN program within 2 years. That means 4 diets. You have drawn your plan. For me to write this ICAN, I need to enroll for a lecture. First, I need to register with ICAN. You now ask yourself, how much will it cost me to register? You now put a value to it. Registration, 50,000 value. I need to enroll for lecture. How much will it cost me? 100,000 value. As soon as you introduce money to your plan, then you have drawn a budget. As soon as money is introduced to your plan, then you have drawn what? A budget. We have defined budget. Purpose of budgeting. Why should we budget? One, budget is a means of translating long-term objectives into short-term achievable plans. Budget is a means of translating your long-term objective into short-term achievable plan. Number two, budget is a means of communicating company's objectives to all members of the organization. By drawing budgets, budget provides opportunity to communicate company's objectives to all members of the organization. Number three, budget can be used as a control tool. We can use budget to control expenditure. Company draw budgets. This is the amount we plan to spend next financial year. That budget is a means of controlling expenditure. All employees, they will be aware that, look, expenditure on labor, this is what management say we should spend. Expenditure on transportation, fueling, management established budget. That budget serves as a means of controlling your spending. Even as a man, you draw a budget. My monthly fuel consumption should be within this range. I'm trying to monitor my expenditure. As a man, I say, okay, my monthly fuel consumption expenditure should not go beyond 100,000. You are drawing a budget. My monthly electricity bill should be between this amount. You are using that to control your spending. You can also use budgets for performance evaluation. Budget can be used to evaluate the performance of individual managers, because you are going to compare budgeted figures with actual results. By comparing your budgeted figures with actual results achieved, you can identify unfavorable variance, adverse variance, or favorable variance. An adverse variance can be an indication of poor performance. Management will investigate. So you can use budget for performance evaluation. All right. We have defined budget. We have explained the purpose of budgeting. Our next discussion types of budget or terms with budget. There's what we call budget manual. A budget manual is like handbook that provide guidance on how budget will be prepared. A company may have a budget manual, a book that provides guidance on how our company budget should be prepared. The budget manual will tell us the objective of the budget, the planning procedure, the instructions and guidance, and details of approval. The budget manual will tell us who and who is to approve the budget. Please be mindful of this point. You are not supposed to act on any budget that is not signed by the approver. You know, in companies, if your boss wants to do some shady things, they will transfer document to you without signing. Some of us might have experienced it. Your boss didn't send you mail. Official mail is a way of signing. Your boss is now telling you with a word of mouth, saying that, oh, Landy, please transfer 3 million to this account, without giving you a signed document. You are now acting on a word of mouth. Please note, you can only act on approved budgets. So the budget manual will tell us Details of approvals. Our next discussion, principal budget factor. What is principal budget factor? Principal budget factor is also known as key budget factor. The principal budget factor is that factor in the budget that will set limits for the volume and scale of operation. Principal budget factor. That factor that will set a limit for us on the volume of operation. Principal budget factor. That factor that acts as a limiting factor, a binding constraint. For example, sales volume is usually the principal budget factor. For example, in most cases, for most organizations, sales volume is the principal budget factor. Look at equity professional. On this platform, I have like 24 students. On this platform currently, we have like 24 students. And we can accommodate 100 students on this platform. Our capacity can accommodate 100 students. The volume of sales is limiting our ability to make profits. Whatever limits a company from making more profits is what we call principal budget factor. We are willing to produce as many units as possible. But we must be guided by what? Customer demand. That customer demand is your sales volume. If you keep on producing without looking at what the customers are willing to buy, volume, you are going to be incurring costs. And you cannot sell all your products. So the principal budget factor is your sales volume. Usually, whatever limits a company from making more profits is called principal budget factor. That is why the first budget you are going to prepare is your sales budget. For most organizations, the first budget to be prepared, the first budget to be developed is the sales budget. How many units is the customer willing to buy? What is the estimated sales volume? For equity, we are going to ask ourselves, how many students are likely to enroll for this class? Volume of sales. All right. My next discussion, the type of budget. We have several types of budgets. But today I'm going to focus on maybe two or just one, so that we can take question again. We have functional budgets. Functional budgets, otherwise known as operational budgets. What is functional budget? A functional budget is that budget that deal with operational activities. In a manufacturing company, your functional budget will include your sales budget, budget within your operations that involve operations. For a typical manufacturing company, functional budget will include sales budget. Your sales budget will show the quantity, budgeted quantity for sales, and the budgeted selling price. Your sales budget will show budgeted sales volume and the budgeted selling price. Hence, you can derive the budgeted revenue. That is the first budget company will prepare. From your sales budgets, we now have production budgets. Production budget is prepared on the basis of sales budget. Production budget is prepared on the basis of sales budget. Your production budget shows the quantity to be produced so as to meet customer demand. Your production budget shows the quantity to be produced so as to meet customer demand. Please take down sample of production budget. Sample of production budget. Please note this in your book. It's not writing now. Hey, just 1 minute. Why is it not picking my pen?
It has hung probably.
Okay. You can't hang. Why is he hanging?
Maybe you need to log out and come back.
Why is he hanging now? Why now?
Stop sharing and reshare.
Can you see my screen?
Yes, sir.
You should not angle. Sample production budget. Why now? No, please don't hang up. You are going to start with your plan sales. Plus desire closing stock of finished goods. Desire closing stock of finished goods. Add it. Minus opening stock of finished goods. Less this. That will give you production budgets. Before rejects. Production budget before rejects. Plus anticipated rejects. In brackets, if any. Add. This will now give you total production budget. Carefully study this. Please transfer it to your notes. At any time you are asked to do production budget, just be looking at it. Plan sales in units. Plan sales in units. Plus your desired closing stock of finished goods minus opening stock of finished goods. That will give you production budget before rejects. Then plus anticipated rejects. What is reject? If you
That's the
produce,
question.
and of course now, you know, if you go into production, company have what we call standard output. I have a close somebody that work with UAC. There's what we call standard output. If you produce gala, there's what we call the standard output. If your final product does not meet the standard output, they will drop it under rejects. This is not up to standard. They will say that to customer. If you produce phone, there's a standard output in terms of battery life, the keyboard performance, the processing speed. If you are done producing your phone, before selling to customer, they will now transfer to quality control, the quality control department. If the outputs meet the company standard, if it is below standard, that phone will not be sent to the public. That will fall under production rejects. All right. So after your production budget, we now prepare raw material purchase budget. For me to produce, there must be raw material. The next budget to be prepared after production budget is your raw material purchase budget. The raw material purchase budget shows the quantity of raw material needed to meet production. The raw material purchase budget shows the quantity of raw material needed to be able to meet production and satisfied inventory requirements. Company will have policy on inventory. Now, listen to this again. Raw material purchase budget is that budget that shows the quantity of raw material needed to meet production, as well as to meet the inventory management policy. A sample of raw material purchase budget is shown below. Raw material purchase budget. Raw material purchase budget is developed from production budget. We are going to start with planned production. How many units will I produce? Next, multiply by material required per unit. For me to produce 1 unit, how many material required? You are going to multiply plant production by material required per unit. That will give you total material usage. Total material usage. Plus desired closing stock of raw material. That is the inventory management policy. What is the closing stock? Management said we should maintain. You are going to add this minus opening stock of raw material, RUM, please. Minus this. This will give you material purchase before wastage. Before wastage. Add anticipated material wastage. That will give you total material purchase. Please, if you are advised, transfer this to your notes. At any time you want to do material purchase budget, just be looking at it. What is material wastage? Let us explain that briefly. If you are involved in production, if you are cooking at home, as you are trying to mix your flour, imagine you want to bake cake at home. If you are mixing your flours, some of this flour quantity will split on the floor. So, some question. Examiner will give us anticipated wastage. We expect that 5% of our material will be wasted in the cost of production. That means management has prepared for it. If you are aware that if I go into production, 5% of the raw material purchase will be wasted. That means if you want to purchase, you are going to purchase both material required for production and your anticipated wastage. This is how to prepare. Thank you. This is how to prepare raw material purchase budget.
Can you scroll up a little bit so that we can see the heading?
Why not? Okay, you can go through it in the next document in your book. So we have discussed functional budget. We have discussed functional budgets. I'm still around here. Let me take a walk. All right, are we good to go now? Are we good to go?
Yes, sir.
Right. My first focus is on the budget that involve calculations. So we have discussed functional budgets. We have other budgets, rolling budgets. What is rolling budget? Let me explain briefly. Let's explain briefly. When you say rolling budget, a budget that will be updated at every interval. A budget that is updated at every interval to maintain a particular budget period. Let's illustrate this. If you want to talk of rolling budgets, assuming in our company, management says you must prepare, we must be having budget for three months using a rolling budget. A rolling budget preparation. Our budget period is 3 months. Using a rolling budget style. That means you are going to prepare budget for the first 3 months. January, February, March. The first 3 months of the year. Now, after we finish February, you are going to delete, after we finish January, you are going to delete January budget. You now update with April. It becomes February, March, April. 3 months. After we finish February, you are going to delete February budget. You update with May. It becomes March, April, May. This is what we call rolling budgets. The budget is updated at regular interval based on the period specified by management. That is rolling budget. Incremental budgeting. I'll come back to zero budgeting. Incremental budgeting, whereby a budget is prepared by increasing previous year budgets with a certain percentage. Incremental budgeting system. Budget is prepared by increasing your previous year budget with certain percentage. This is very easy to prepare. Assuming last year, 2024, your budget, the budget you give yourself is 50 million. And your budget is based on incremental system. That means this year, if I spent 50 million last year, let me increase by 20%. I should be able to spend maybe 65 million this year. That is incremental budgeting system, whereby the budget is increased every year with a certain percentage as decided by the management. This is what we use in Nigeria. Go and check Nigerian budget. Go and check Tinubu's budget. Tinubu's budget in 2023 compared to 2024, it has increased. 2024 compared to 2025, it has increased by a certain percentage. That is incremental budgeting system. We have zero-based budgeting now. Now, before I go out of that, although incremental budgeting system is very easy to prepare, it's very simple to prepare. In fact, it's a lazy man way. It can give rise to budget slack. One disadvantage of incremental budgeting system is that it can result in budget slack. What is budget slack? This is what we call budget padding. You just assume that because you spent 100 million last year, increase it by 50% this year, I'm going to spend 150 million. You just assume on your own. That gives rise to corruption and stealing. That gives rise to what? Budget slack, inefficiency. To correct this inefficiency, we now have zero-based budgeting. Zero-based budgeting is to correct the inefficiency or the limitation of incremental budgeting. What is zero-based? Zero-based budgeting assumes that there's no budget for any department. There's no budget. There's no money that will be allocated to any department. No money will be allocated to any department of the organization until the departmental manager justify the money to be spent. Under zero-based budgeting, all departmental head will go to management and justify the reason why you must spend this money. So if you say you want to spend 5 million on feeding every month, 5 million for canteen expenses every month, management will now ask you, please come and justify this 5 million. Before we can approve it. That means all items must be justified for expenditure purposes. One advantage of zero base is that it removes inefficiency. It removes corruption and budget padding, but it can consume management time. You are going to be justifying everything. You want to spend money on transport, justify. Money on feeding, justify. Salary payment, justify. Training expenses, justify. Most managers will be tired. Everything, justify, justify, justify. Most managers like to spend money without subjecting them towards, justification. Most individuals like to spend money without control. It's a nature of human being. Imagine in a family setting where the husband is asking the wife, come and justify the money you want to spend. Sorry. Come and justify the money you want to spend. In a family setting, what do you want to spend for pepper? How much for meat? How much for fish? The woman will be tired. The same applies now. Under zero base, it consumes management time. The time you have spent to be doing the work, you are going to justify why you need to spend money. All right? We have top-down budgeting system, whereby top-down budgeting system, the budget is prepared by the top management and transfer to the lower level for execution. Top-down budgeting system. Budget is prepared and developed by the top management. This will be given to the lower level managers to implement the budgets. Such budgets, although is very simple, it shows what the management, what the company want to achieve. It eliminates time wastage. But one major limitation is that it does not involve the operators. People that will implement the budget are not involved in the budget preparation. Such budget is likely to fail. There must be budget participation. You must try to carry out, you must try to carry along the top level managers, must try to carry along other staff in the budget preparation. Then we have bottom-up budgeting system. From the bottom up. In this case, this is the opposite of top-down, whereby the operators, the lower level manager, will prepare the budget on their own. They are the ones that want to act on the budget to top level manager for approval. that is bottom up. This budgeting system is advantageous in the sense that the operators are involved. They are involved in the preparation of their budgets. They will believe that they have sense of ownership. The man that is supposed to implement the budget is asked to prepare the budget. This man will be motivated to ensure that the budget is achieved. But what are the limitations here? Or what is the major limitation here? Is that if you allow lower level to do the budget, they will deliberately create room for less performance. Assuming you can produce 10,000 every month, and you are asked that how many can you do every month? You tell management that I can only do 8,000. You are likely going to tell manager that every month, so I can only do 8,000. You know fully well that you can do 10,000. You now say you can do 8,000. If manager approve 8,000 for you, you now try to do 8,500 or 9,000. You'll be claiming that I even try to surpass the budget now. I produce 9,000 in a month. You know fully well that you can do 10,000 because you are trying to hide underperformance issue. You now reduce what you can do. All right. We have like 30 to 40 minutes. Periodic budget, of course, most budgets are periodic in the first place anyway. I think that is trying to master budgets. Periodically, budget must look at 12 months. In most cases, companies draw budgets to cover 12-month period. And that is your master budget. We have activity-based budgeting, whereby a budget is developed on the basis of activity-based costing. Recall, we have treated activity-based costing. You can prepare your budget on the basis of activity-based costing, or you can use absorption costing method. For most organizations, they use absorption costing method. What is absorption costing method? A costing method that incorporates both the variable cost and the fixed cost as part of your overhead accounting. If you are talking of activity-based, that means we are going to identify the activities that give rise to the cost as a basis for budget preparation. We have flexible budgets. We have fixed budgets. And we have flex budgets. We have flexible budgets. Let me add this to it. Okay, let me use pay. Because you cannot explain flexibly. There's what we call fixed budgets, flexed budgets. We have to take these three together. For me to explain this, if I explain flexible budget only, you won't appreciate it. We have to bring these three variables together. All right. Let me go to the page below. I want to explain these three terms. Please permit me to create more space. All right. 1, fixed budget. Fixed budget is the original plan of the company. A fixed budget is the original budget. What the company intends to achieve originally. A fixed budget is that budget that is not designed to change. A fixed budget is that budget that is not designed to change. It is the original plan of the company. This budget is prepared prior to the budget period. For example, let us use Nigerian Bottling Company. We are in October now. Most companies will prepare their budget between October and November, assuming the budget of Nigerian Bottling Company, budget for 2026. NBC plan to sell 500 million bottle of Coke. The managing director of Nigerian Bottling Company says that in 2026, our budget is to achieve 500 million bottle of Coke, says. This budget is prepared in October 2025, prior to 2026. Nigerian bottling company is planning to sell 500,000 bottles of Coke. That is the original plan. That is the fees budget. On this basis, we are going to have, based on 500 million, you are going to have budgeted revenue. Budgeted costs, material costs, labor costs, overhead costs. Budgeted revenue minus budgeted costs. That will give you budgeted profits based on 500 million bottles of Coke. That is the original plan of Nigerian bottling company. This plan is not expected to change. That is what we call fixed budget. A budget that does not accommodate changes. We now come to flexible budgets. We now come to what? Flexible budget. Budget also prepared along with your fees budget. Flexible budget will be prepared along with the fees budget. Why? Why are we doing flexible budgets? Because we are aware that budgeting involves uncertainty. Budget is prepared based on estimates and assumptions. There is the possibility of errors in your estimates. Budget is prepared. The original budget is prepared based on estimates and assumptions. There is the possibility that there could be error in your assumptions. There could be errors in your estimates. To try and minimize error, we now prepare a flexible budget. In other words, flexible budget is prepared to try and reduce the possibility of errors and uncertainty. This budget is also prepared prior to the budget period. Look at it. We now have flexible budgets. This will be prepared on different assumptions. You can say, okay, let us do a flexible budget for 350 million bottle of Coke or 600 million bottle of Coke. Because we are not sure if the demand will be up to 500 million. Assuming the demand for Coke in 2026 falls, let us work with 350. Or let us work with 600. Budget based on different assumptions. The flexible budget is prepared to accommodate changes in circumstances. Flexible budget is prepared to accommodate changes in circumstances. It's very possible that material costs will increase or fall. Labor costs may increase or fall. Overhead costs may increase or fall. You now prepare flexible budgets on a different assumptions. So please note, flexible budgets, budget prepared alongside fixed budgets that can accommodate changes in circumstances. Number 3, your flex budget. Your flexed budget. This budget will be prepared at the end of the financial year. That is at the end of 2026. Where you have the actual results. Let us assume that at the end of 2026, NBC actual sales, actual result shows actual sales 450 million bottle of Coke. Remember, the original budget is 500 million. Nigerian Bottling Company is able to achieve 450 million at the end of 2026. Look at it, please. The fixed budget is on budgeted sales 500 million. Please note, please. You cannot compare fixed budgets with actual results, because the volume is not the same. The volume here is 500. The volume here is 450. You cannot compare actual results with fixed budgets. You now prepare another budget called flexible budget. Sorry, flex budget. These flex budgets will be prepared based on 450 million, because this 500 cannot work again. You are going to prepare a flexed budget using volume actual results. Actual result is 450 million. You are going to pick the actual volume against your budgeted revenue and cost. Let me explain that briefly. You are going to pick 400 million, 450 million. You now ask yourself that if the actual sales is 450 million, what is the expected revenue? You now pick budgeted selling price multiplied by 450 million. That will give you the expected revenue. If the actual sales is 450 and our budgeted selling price is 100, then the expected revenue should be this. You are now using the actual quantity against your budgeted items, budgeted selling price, budgeted cost, material cost, budgeted labor cost, budgeted overhead. You are trying to now flex your budget. You are now done with flexing the budget using the actual production volume, actual sales volume. Please note, you can only compare flex budget and actual results. You can only compare. Please note this very well. Your flex budget now. The flex budget will now be on 450 million volume. Actual results will be on 450 million. You have flexed the budget. You can now compare flex budgets and actual results. They must be on the same word, volume. Please note, the process of flexing a budget is what we call variance analysis. The process of using the actual volume to flex your budgeted revenue and cost is what we call variance analysis. You can now compare flex budget and actual result. That will give you the variance. That is the explanation. That is the explanation. The last discussion is what we call financial budget, because we can't solve any question again today. The last discussion is what we call financial budget. Your financial budget will include cash budget, your financial budget will include 1, cash budgets. 2, profits or loss budgets. And 3, I need to round up because I have another class. Then 3, budgeted statements of profits. Oh, sorry. Budgeted statement of financial position. What is your cash budget? Your cash budget. Budget prepared to identify cash surplus or cash deficit. Your cash budget. Budget prepared by the account department. To identify either cash surplus or cash deficit. Where there is cash surplus, it is your responsibility as the accountant to invest the cash surplus. Where there is cash deficit, that is cash shortage, it is also your responsibility. It's also your responsibility as accountants to identify ways to finance the cash deficits. Your cash budget is prepared on cash basis. Cash inflows minus cash outflows. That's all. Your cash budget, you are going to compare the cash inflows with your cash outflows. Profit or loss budget. This budget is prepared on a pura basis. This budget is prepared on a pura basis. That is, you are going to recognize sales once made, and cost will be recognized once the cost is incurred, whether we pay for it or not. Finally, budgeted statements of financial position. Budgeted statements of financial position of the company at a specified future period. Budgeted statement of financial position shows the company's asset and liability at a specified future period. An estimate of your asset and liability at a specified future period. That's all about budget. All discussion on budget has been completed. The only thing remaining for me or for us is to put question to this. And that will be done on Sunday next week in your class, by God's mercy. All right? We are done with this discussion. Any question, comments? Clarifications?
Budget.
If there's no question,
Hello, sir.
yes, any question, promise.
Yes, sir. So I want to ask, when it comes to inflation, can we use incremental budget to inflate our figures?
Yes, if it is, in fact, one of the reasons why people do incremental is to accommodate inflation. One of the arguments for incremental budget is that the amount spent last year, the cost incurred last year, there's inflation. So you can use inflation to increase your budget cost item. However, that is not the basis for incremental budgeting preparation. Inflation will affect all budgets, whether zero base, whether rolling budgets, whether flexible budgets. So it is allowed to incorporate inflation in your budget. Is that better, please?
Okay, sir. So including the fixed budget, can it be inflated?
Of course, all budgets we accommodate inflation. I need to check out your classroom. I have other classes to attend to.
Hello, sir.
Yeah, please speak up.
Yes, sir. Please, I want to ask based on final budget. Do we have, because during our in foundation we did something called final budget. Is it also in our
Your final
syllabus?
budget is your master budget. Profit and loss account budgeted, that is your final budget.
Oh, okay.
Your
sir.
final budget is your master budget. At the end of the period, the intent of this budget is to determine the profit we are going to make. Is that clear, man? Hello, man.
Yes, it's clear, sir. Thank you.
So if you are doing budgets, what you are trying to say is that what is the profit I'm going to achieve at the end of that budget? That is the final budget. Budgeted profit and loss. And that will be under your master budget. It will show your profit and loss budget, your budgeted balance sheets. All right, thank you for your time.